The FOMC's first meeting of 2025 is underway. As of this morning, the CME FedWatch tool is expecting the Fed to hold rates steady at this month's meeting as inflation cools and the labor market remains strong. But my next guest says there are several major issues that could reignite inflation. Neil Mukherjee, who is the TIAA Wealth Management Chief Investment Officer, joins me now. Neil, great to see you and thanks for joining the program again. You say that the biggest risk to inflation is inflation returning is economic growth, which under normal circumstances, that would be a great thing. So why is that the biggest risk?
Yeah, well, Brad, great to be with you, and good morning. Listen, the U.S. economy the pace of growth is quite remarkable, even now, 2.5% to 3%. You have a labor market which is still pretty strong, creating jobs at a consistent pace. The unemployment rate is low from a historical perspective. Whoever wants a job basically has a job at this point in time. And then we look at consumer spending. Consumers really haven't slowed down their pace of spending. And some of the spending is being supported by the higher income consumer, which is enjoying record levels of net worth. But also they're earning a lot of returns from their cash on the sidelines. So they're spending on the services side of the economy. And then investments into factories, into data centers, into research and development, et cetera, is quite healthy and good. So economic growth is quite firm. So from a Fed's perspective, if they stick to their 2% inflation mandate, they might be a little bit challenged. Now, if they're accepting of a higher level of inflation, then it's a different story. But economic growth, which is good for the stock market, for investors, still looks pretty robust to us.
Yeah, they've stood firm by that 2% target that they want to get us long run back towards here. You also lay out 4 other policies from President Trump that could be a risk: tariffs, immigration crackdown, higher deficits, and deregulation. So how are those potentially inflationary?
Yeah, Brad. So let's take them one at a time. So look at immigration, for example. There's no doubt that net immigration into this country over the last few years has increased the size of the labor force. It has enabled the economy to add jobs in a non-inflationary way. It has extended and provided longevity to this business cycle. So if you reverse some of that, that could mean a smaller size of the labor force, higher wage pressures on the margin. It could also lead to higher or lower demand on the margin as well. Now, Trump, the candidate, called for 15 million deportations. Let's see how much can really be done. That's the real story here. And we already see that the new administration is running into logistical issues and cost issues and even legal challenges. But the reversal of immigration certainly can be one of those inflationary forces. Let's talk about tariffs for a quick second. So tariffs, it's a little bit more complicated because the impact of tariffs on inflation and the economy in the medium term and long term is not very clear. But what I will say is, if you put it simply, higher tariffs means higher prices of products and services being imported into the country. And there's 2 things you can do with those higher costs. You can either pass it on to the consumer if the consumer is willing and able to accept it, or you can absorb it as an importing country into your own cost structure. So both those scenarios are not good for the economy, for inflation, for corporate profitability, and for stock prices. Now, the other wrinkle to the tariff question is the second order impact of tariffs is even harder to gauge. So you could have a situation where the dollar could appreciate. That could negate the impact of the tariff against the currency of the country you're putting the tariff against. And the other countries can retaliate against the U.S. companies and U.S. economy, generally speaking. They could stop the export or slow down the export of critical raw materials, components, materials that our industry needs. So that makes it a little bit more complicated from a growth and inflation perspective. Now, you mentioned deficits, and the key to that is the extension of the tax cuts. So whether you extend the tax cuts or you have new tax cuts in the system, in the near term, that provides a boost to economic growth. So lower taxes means more spending by consumers, more money in their pocket. Lower corporate taxes could mean higher corporate cash flows. more investments, more hiring, a stronger labor market, more consumer spending. So all of that is good, more productivity for the economy. However, tax cuts are not free. So they can come with a higher deficit, and we are already running 6-ish% deficits, and that can lead to higher interest rates. So again, that can mitigate some of the positives that come with tax cuts. And that's why I think the main theme this year is all about how much can the new administration really get done, and how much will the bond market let the new administration get done this year.
And so for the Fed, they're unlikely to front run what the policies are, but to the extent that we hear in their tone how they're thinking about or how they're going to be talking about tariffs as they do get implemented, or even how immigration policy and mass deportations, how that might be felt in the employment situation as well. What do you expect to hear from them tomorrow, and how does it set the tone going forward, and how they're going to be tracking some of those policy announcements from the current administration?
Well, Brad, tomorrow's meeting is going to be like a walk in the park for Chair Powell compared to some of the recent other meetings that he's had to go through and pressers. But to your point, it's interesting. The assumption that most people made coming into the December meeting was that the Fed will not really react prematurely to any major policy shifts by the new administration. It's going to wait for the policies to come into focus. It's going to observe the impact on the economy and then make changes to their forecast and then make changes to their monetary policy stance. But what we saw was some members of the FOMC actually started to incorporate the economic impact of the new administration's policies into their forecast, which was a little bit surprising, but which also tells me that those dots maybe move around a little bit more in the next couple of quarters. That can lead to some confusion with respect to the Fed's reaction function, and that will lead to more bond market volatility down the line. Yeah. Now, coming back to the Fed one more time and their focus for the next few meetings, listen, the Fed is in a difficult spot. They have cut interest rates by 100 basis points. The data has been quite firm, both on the growth side and on balance on the inflation side as well. So they did the right thing when they came into the December meeting. They pulled back their expectation for the number of rate cuts they're looking to do this year. And they pivoted more towards the risk of inflation breaking out away from the risk of a weaker labor market. So that's right. Good. Now, the key here is the neutral rate.
Yeah.
Where is the neutral rate? So there's a lot of disagreement on that among Fed officials, among market economists. The Fed seems to think that the neutral rate is more than 100 basis points below the Fed funds rate. Many market economists believe it's 25 basis points to 50 basis points below where they are now. So if inflation data cooperates with the Fed, they're likely to go ahead and do the 2 rate cuts that the market is pricing in now.
Right.
If you watch the unemployment rate, if that moves up, you will get more rate cuts this year.
Neil, we got to leave the conversation there. Always a pleasure to grab some of your insights. Thanks for joining us.
Thanks, Brad.